Hurricane Harvey flooding Houston, North Korea firing missiles over Japan, central bankers moving from QE to QT. You know, at times it feels like locusts, the plague, and bad reality television all hitting at the same time. Today on CFTC Talks, we cover the major risks facing the U.S. and global economy. I'm your host, Andy Bush. Remember, there's an important disclaimer at the end of this that you should listen to. Now, Mama said there'd be times like these, and she wasn't kidding. There's a wide range of challenges facing the U.S. economy, the world's economies, really, overall. While growth has continued to surprise in a positive way, there are things out there that appear to be lurking behind every rock and tree in the economic forest, just waiting to jump out and spook us. So for some clarity and calmness, we turn to someone who's been covering this space for a long time and hopefully some wisdom as well. I'm sure we're going to get that. So James Glassman is a managing director and head economist for commercial banking at JP Morgan. He is also a longstanding participant at the Federal Reserve Bank of Philadelphia's survey of professional forecasters and the National Association of Business Economists, NABE, panel of microeconomic forecasters. From 1979 through 88, Jim served as a senior economist in the Research and Statistics and Monetary Affairs departments at the Federal Reserve Board in Washington, D.C. He joined Morgan Guaranty in 1988 and Chemical Bank in 1993, which through a combination of mergers became JP Morgan Chase. He's got a bachelor's degree from University of Illinois at Champaign, a master's degree in economics from the University of Illinois at Chicago, and he's got his PhD from Northwestern. I love it that you're from kind of all the areas of Illinois that I like. Jim, welcome to CFTC Talks.
Thanks, Andy. Glad to be here.
Great. Hey, before we get to the scary stuff, really, let's talk about the good things that are happening out there in the world, because we don't want to freak everybody out right away. But starting in the United States, what is your forecast for Q3 and Q4 GDP?
You know, roughly 3.5 to 4.5, I think, is possible in the third quarter. I think the year is going to turn out to be a 3% year.
Wow, that's really strong, and that's much stronger than what we were anticipating from the beginning of the year, right?
Yeah, everyone's thinking that we're in this 2% growth track, and the reason for that is the last couple of years have been roughly 2%. If you look at the growth over the whole expansion, we've been running around 2%. But the last 2 years were held down by big adjustments going on in the energy sector. So CapEx, profits, rail shipments of oil. That was a really dramatic adjustment taking place in the energy sector when oil prices fell more than half.
Right.
Now most of that is passing, and we're starting to see activity picking up again in the energy sector. Thankfully, our trading partners in Europe and Japan are starting to pick up speed. They were sort of slow in reacting to their crisis, sort of mimicking what the Fed was doing. Now we're starting to see better performance there. And frankly, with the equity market up, creating more than $3 trillion of wealth in the last 8 months, you ask most economists, what would you expect this to do to consumer spending? It doesn't take a lot of imagination to believe that this year should be something like a 3% year relative to what we have been doing. To sustain that, though, I think we need a lot more than just what we've seen. This is all short-term stuff. There's some drags that are fading. So right. I don't think it's a real stretch to talk about 3% growth this year.
Wow, that solves a lot of problems with 3% growth. So let me get into the weeds a little bit with you. So from what I'm hearing, it's been a combination, it appears to be, of the consumer and CapEx as both have been contributing this year a little bit stronger than what most people thought was going to happen.
Yeah, but I mean, really, the lights came on in the energy sector at the start of the year. You saw that in the layoff trends in Texas and Oklahoma, Arkansas, North Dakota. CapEx was picking up. It's unbelievable that even though oil prices are here half the level they used to be, we're now producing as much oil as we were before the decline in prices. So it tells you the industry has gotten much more efficient, and things are starting to pick up there. And along with that, you're getting the consumer. The news on the consumer is actually better than people think. We're getting more and more information as the stuff rolls in that the consumer is doing pretty well. And you'll see that when we get into the third quarter GDP figures. You wouldn't be surprised to see that, right? When you have this kind of increase in wealth, people feel better about their real estate house prices. Those trends are pretty good.
Sure.
And the job market is quite good. So there's nothing really bad to talk about for the consumer.
Well, one of the conundrums, I think, for the Federal Reserve as they look at things are two areas, and I know you're really all over this, but one is productivity and the other one is inflation. And obviously those two are related, but I remember speaking to you, we were outside at some place in New York, it was beautiful out, and you were telling me, and you were holding your phone saying, I don't think the Federal Reserve can pick up all of the productivity that comes from this amazing little computer that's in your hand.
Yeah, I think that's part of our problem is that we've seen this story before, by the way. We saw computers spreading everywhere, but we weren't seeing them in the numbers, and it turned out that we weren't really measuring what computers do very well. So here's the problem. This is the conundrum. We see innovation all over the place.
Right.
We see people worrying, wringing their hands about all this autonomous technology and transportation. What are we going to do with all these people?
Robots, right?
Yeah, and the robots, and yet we don't see it in our numbers. And I think it's a reminder, there's a lot of new things that are going on in the last 10 years, the digital economy, the sharing economy, the Amazon phenomenon. We're just not picking up a lot of, there's things in there that are not getting picked up. When I rent an apartment from somebody through Airbnb,
sure,
I'm pretty sure my outlays are not being picked up in consumer spending figures. So I think we need to be a little cautious about concluding that productivity is dead when we're not sure we're really picking up a lot of the things that are going on. I just think about my own life. The amount of effort I put into doing certain things is vastly shorter than the time it used to take me. And it's implausible to me that all that's going on is not helping to boost our productivity. And it just may mean that it takes time to sort of see this all play out, and we need time to sort of catch up to all this stuff that's going on. So, yeah, productivity is a big issue if we're in the middle of a slowdown, but that is a big issue. But I doubt that's happened. I think we're going to find out that all this innovation really is actually helping us do things a lot better.
Right. And just to connect that for the audience, just so you know, why we care about productivity, because, I mean, quite simply, GDP is productivity times the number of workers, right? So if productivity is not being reported properly, if it's lower, then GDP is lower. And what you're saying is, hey, we're not picking all that up. So actually, we're probably seeing faster economic growth because of that. Let me talk about inflation a little bit, Jim, because I think this is also one of the biggest problems for the Fed is just trying to figure out why is inflation remaining so low, given the fact that the unemployment rate remains very, very low.
Yeah. Well, I mean, if I were at the Fed, it's not a problem, right?
Right.
If you're at the Fed and you're not getting as much inflation as you feared, all that's telling you is that the economy has the capacity to do better without causing problems. At the end of the day, what they care about, they've got a target for inflation. That's the ultimate target is 2%. And if we're getting signs that maybe inflation's not as bad as they thought, that just means we have the capacity to do better. But I think also we have to remember that there's two kinds of inflation. Disinflation that comes from a inadequate demand is the kind you worry about. But, when you look at the labor market, look at what's going on with our economy, there's very little sign that we're stagnating, that we're not getting enough demand. Employment keeps getting better, unemployment keeps coming down. So this is not the 1920s. This is not the Great Depression era.
Good.
We're at insufficient demand. We are getting, there's another kind of disinflation that comes from technology. The Verizon offering of unlimited data, the pharmaceutical stuff. These are all things that when you get inflation surprises, what they mean is that people have more resources to spend on something else. So eventually, the inflation moderation that we're getting is helping people. And, I would worry about inflation if I were the Fed, if the economy was floundering, but it doesn't seem to be. And so I think this is the good kind of deflation that we're getting. And honestly, I think for the Fed, they've got to take a longer view. You got to use your judgment. Is an economy that's getting closer to full employment mean that eventually you're going to be able to reach your inflation targets? Or do you believe inflation readings? I mean, these things can pass on, can come and go quickly. So personally, I think they've got the right idea. The driving view at the Fed has always been keep your eye on the state of the labor market. That's a really good indicator of how the economy is doing. And if we're getting closer to full employment, and we're probably there, that tells you there's really little reason to have interest rates at emergency levels. And the goal at the Fed ought to be, and I think it is, to try to lengthen the life expectancy of this expansion, because the history books tell you once you get to full employment, you often don't stay there. You usually trip up and go into some new downturn. Sometimes the problem is keeping rates too low, creating new imbalances.
Let me switch gears a little bit and get to some of the research that you've written recently. One of the things that we want to know about at the CFTC is understanding the market narrative. And one of the market narratives you mentioned in your research is that there's a lot of skepticism out there about this recovery and that the positive financial market readings are too good to be true. PE ratios are too high, volatility too low, and credit spreads are too narrow. Are these indications of upcoming problems?
No, people look at this and they forget that financial indicators are just a mirror of what's going on in the economy. When people tell me asset values are too expensive, they may be expensive relative to the current level of earnings, but if this recovery continues, investors don't care about the present. They're looking into the future and asking themselves, what's the next several years likely to look at? And that's why asset values often, the financial markets are always several steps ahead of reality. So at any point in time, it may look expensive. There's a famous guy who 4 years ago told you that the stock market's too pricey. And that's because he was looking at the current level of earnings. And so it's always about what does the future look like.
Yeah.
And that's why I think it's important to know that if you say, now that we're back to full employment, if we're now going to sustain this level, earnings are going to grow. Everything's going to do better over the next several years, and that's what's driving investors' views.
Well, we just finished the annual KC Federal Reserve Jackson Hole meetings where both ECB's Mario Draghi and Janet Yellen spoke, the Fed's Janet Yellen. What were your top, three takeaways from these meetings, if there were any? I mean, I know there wasn't any earth-shattering news at these things, but you followed this pretty closely, and I think that was a big focus for the financial markets.
Yeah, I don't think the market's heard anything new here. I mean, the Federal Reserve is getting set to start to shrink their balance sheet.
Right.
They've been warning us about this. The issues tended to be more focused on long-term issues, and I think for economists in general, there's a concern that, with the demographics slowing down, the growth in these economies are slowing down, and I think that is not, by itself, not an issue. The issue is whether productivity is slowing down, whether Janet Yellen gave a defense of all that's been going on in the financial regulation to say that we've made the system safer, let's not dismantle all this, because there is pressure to do this. And I think that was, it was a strong defense for what they've done and a belief that the financial system is safer. So I don't think we learned anything really that we didn't know was coming. We expect the Fed to continue this process of normalizing policy. We think the Europeans won't be that far behind them. I mean, they have more slack, more unemployment, but their economy is starting to do better too. So I think the market didn't hear anything new from this conference. There have been a few that have been quite important. When Mr. Draghi signaled the need to do asset purchases a couple of years ago, that was a big deal. We didn't hear anything like that at Jackson Hole.
Well, is that one of the biggest surprises, economic surprises this year, is how well Europe has performed?
It shouldn't be surprising. I think people got overly pessimistic because back in 2014, when Europe began to see inflation coming down in response to, they stalled out back in a couple of years earlier, and their unemployment went up. And so all of a sudden we began to see inflation drifting down. Then Mr. Draghi said, we need to do something more. And basically the message was we're going to follow the lead of what the Fed did, more asset purchases. And at the time, what happened is the euro came down from $1.40 to toward parity. Right. So when your currency drops 20%, that has a big impact on your economy. So in retrospect, we shouldn't be too surprised that the European region is doing better because of finally the European Central Bank went on the offense, and that brought the currency down. And and we're seeing the same story play out in Japan, by the way.
Right.
When the Japanese decided to do this, when Abe won his election, the central bank said, we're going to do asset purchases just like you guys, and we're going to aim for 2% inflation just like you guys. Their currency dropped dramatically from 80 to 120. And when that happened, by the way, what was interesting about it is the rest of the world was silent. For all of the post-war period, whenever the Japanese would do something and it would weaken their currency, we all complained. And it ties the hands of the Japanese when they're in a crisis. If you can't allow your currency to adjust to your policy moves, you're not going to get much help out of it. And I think that's why from both Japan and Europe, we're seeing much better performance now because we let their actions play through the market. Thankfully, it's important to us because these are important economies, and if they do better, we're going to do better.
Right. So it begs the question now, all three of them have gone through this phase of quantitative easing. Now they're in the process of trying to figure out when they're going to do QT or quantitative tightening. Just run down the U.S., Europe, and Japan, and when do you think this sequence is going to happen?
Well, the Fed was the first one in, right? Back in March of 2009 is when Ben Bernanke announced this. I think it was a surprise to the market because they didn't realize, they thought the Fed had run out of options, and all of a sudden they realized, well, the Fed can buy assets, and that has an effect on long rates. So not surprising. Then the Japanese stepped up to the plate in 2013, and then the Europeans in 2014. So to me, the way I see this sequence playing out is the Fed is the first one to start backing away. We think next month they will announce the beginning of paying down the maturing securities, and that process will start slowly. And it might take about 5 years for them to totally normalize their balance sheet. And I expect that, the Europeans have slowly begun to slow the amount that they're buying. Mm-hmm. So I suspect that the Europeans will be next. Maybe next year we'll see this process start, and then come the Japanese. Maybe the Japanese will come at the same time. So it shouldn't be too surprising. If the Fed was first in, then we should expect that they will be the first ones out. And the Europeans, I think, have the bigger challenge because when we all started to recover back in 2009, the Europeans went through this existential crisis, and their whole region stalled in 2012. And when they stalled, their unemployment rose a lot, so they have a lot more slack in the European region. Surprisingly, though, it's the Japanese that have more disinflation than everybody else. So I think we should expect the Fed does this first, and then the Japanese and the Europeans follow, just because the Fed was most aggressive when this whole thing started. The Europeans and the Japanese really didn't go on the offense until several years after the Fed started.
Mm-hmm. Yeah, that makes sense. Well, let's switch gears here and let's get to the risks. Let's hope this never happens, but certainly what happens if there is a military response to North Korea?
I don't expect it. I really think that a very useful thing to read is something that the history department wrote. And I think that what they said is it really is important to understand the history of all of this that's going on. The grand idea here in North Korea is unification, and they have no intention. Nuclear weapons are a bargaining chip. They would like to cut a deal with the U.S. where the U.S. backs out of South Korea. Of course, all the others don't really want that. So I think it's a scary, dangerous bargaining game going on here. I don't expect any clash to come out of it. And I think it really helps to understand why would this little country be willing to throw a missile at us, knowing the consequences are going to be quite dire. And this has got to be embarrassing. It's got to be confusing and worrisome to the Chinese and the Russians as well. So it sounds scary to the market, but I really think in an event like this, by the way, like the worry that the European Union was going to blow up, I think it's really important to understand the history before we start imagining all the worst kind of things that can happen, because once you understand the history, you realize this is not just a recent phenomenon from North Korea. This is another version of something that's been going on for a long time, and the grand victory that they all imagine, fantasize about, unifying South Korea and North Korea, it's not going to happen because North Korea is not going to give up their weapons because that's a bargaining chip, and we're not going to back away because our participation, our support for South Korea has helped that country prosper dramatically, and it's brought stability to the region, and the Chinese value that, the Russians value that. So, I really think that this is not, to me, it sounds scary because it's a new phenomenon, but when you think about it, the last 10 years, we've come across a lot of scary things. Putin annexing Crimea, the worry that Europe was going to blow up, fall apart,
right.
That would have been scary. Mm-hmm. The government shutdown, the downgrading of U.S. debt for the first time in history. I mean, Arab Spring when we thought the Middle East was coming apart. And none of these things really lasted long. And I think the person who sort of caught how to think about this is Angela Merkel, Germany. When Putin annexed Crimea, she said, look, the Cold War phenomenon is behind us. We left that long ago. We all are living in a world where we're becoming much more dependent on each other. And people who cause trouble like this are going to find it does more harm to them than it does to the rest of us. I think the reality is correct. I mean, I think there's a lot of good stuff going on. The benefits of economic development are enormous. Asia is coming alive, industrializing. And I think all of that is the driving force. We come across these little scary things,
right,
and then they pass quickly.
Those are calming words, to be sure. But I do have to ask you about Hurricane Harvey. Is this only going to be about energy in Houston, or is there a bigger story here?
I mean, it's going to be challenging for them. You know, we've had a lot of natural disasters. They damage a lot of capital. Natural disasters are not good for the economy. They generate a lot of GDP as we try to recover and repair for damage. But honestly, we destroy wealth when this kind of thing happens. The fact that people can't go to work means there's lost opportunities that you can never really cover unless you can make people work more than 24/7.
Right.
You never can. And So these things are always damaging. We probably won't see a great impact on our overall economy, but in the high-frequency news, we'll see a lot of things that look like, economists will be saying, well, X amount is due to the hurricane. But I think we've seen these things happen many times. Katrina, we're going to have a lot of help for the Houston economy, the private insurance, the federal government. And I know of any place in the country that could recover more quickly, Houston is the number one place, because that place, you can sort of feel it in the air when you go there. This is a very entrepreneurial culture. People are very upbeat. They really get down to work. So I think when this thing passes, you're going to see a dramatic turnaround, pick up, clean up, and they'll get a lot of help. So I think we've had a lot of these things before. Sandy in the New York area, and yet when you look back and you see what is the impact on the economy, you have a hard time seeing it in the macro numbers.
Yeah, that's a great point. Well, wrapping this up on the risks, what are the other, give me your top one or two risks that make you worry, they keep you up at night?
The only risk I worry about, because I'm an economist, and this is the risk we all learn when we're in school, when a country has an inflation problem, your central bank has to respond. And so to me, I've always thought the economy does a pretty good job of sort of getting back on its feet. And we've seen that. I mean, it's pretty stunning how quickly this economy has gotten back from the damage of what we saw back in 2008 and 9. So the thing that I've always worried about and thought, is inflation. As long as we're not seeing inflation problems, which then force the Fed to respond, we're in pretty good shape. And I think the only thing to me that would make me worry is if we wake up one day and we realize that we've all been misled by some of the moderate inflation news. In fact, with the economy running much hotter, it turns out that there's more inflation. Well, I don't think that's going to happen, but that's, to me, the main thing that I would worry about. And I think the only other thing I would worry about right now, frankly, is a meteor strike, because that would be bad. But frankly, meteor strike's not going to happen, and I think you could have said this all along. As long as you don't have things that force your central bank to back off from the support they've been giving, then we're going to do fine. And I think the history books are going to show that this recovery was a lot better than people sort of give it credit for. Because when you think about all the real estate problems that we've faced back in 2008 and 9, and all the talk about the Great Recession, here we are. We just wrapped up 8 years of recovery. I never thought it would take 8 years. Frankly, I thought it would take about 10 years to get fully back to full employment. And I don't know anybody who was more optimistic than that. So, you have to say the economy's done a pretty good job.
Jim Glassman, Managing Director and Head Economist for Commercial Banking at JP Morgan. Thanks for coming on the show today.
Thanks, Andy. Have a good day.
Thank you. That's it for me, Andy Bush. We'll be back next week covering the market narrative and factors influencing the markets we watch. This has been CFTC Talks. Thanks for listening. But wait, there's more. Disclaimer time! The CFTC is providing this information as a public service and is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in the podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provided similar services to those of the guests. The views and opinions expressed by the guest in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to the accuracy and relevance of the information incorporated and referenced in this podcast and assume the entire risk related to its use. The CFTC is providing this interpretation of market trends solely to inform the public of a framework for projecting future outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult with an attorney.